I'm Adam Myers. I lead the distribution team at Pengana. Thank you for joining us for this webinar update with Ed Prendergast, the co-portfolio manager of the Pengana Emerging Companies Fund. From a format perspective, Ed will keep his prepared section to around half an hour, so we will have plenty of time for Q&A at the end. I'm sure everyone knows the drill by now, but the Q&A box can be accessed from the icon on your screen. Hopefully at the end, if the questions are good, hopefully at the end we'll have a very interesting conversation. So Ed, pausing briefly on the disclaimer, over to you.
Thank you very much for your time, everyone. Much appreciated. I'll get Aidan, if you can just fast forward. Let's pop there for a while. So I'm Ed Prendergast. I co-manage the Pengana Emerging Companies Fund and with Steve Black, and we've done so in the same structure for 19 years. Well, it'll be 20 years this October, and nothing about what we've done has changed since day one. If we were to put this chart in front of you to describe what we planned to do 20 or 19 years ago, it would read exactly the same. So the process, well, firstly, the people behind it. So Steve and I, we're still very much involved, and we've never had staff within the business. So it's definitely a fund that is run by only us. We've known each other. We knew each other for 10 years prior to that, so we're familiar with how we operate. And it's not to say we agree on everything, but we're certainly familiar at that level. And the structure of the business is that the ownership of, so we half own the business and we half own the half, which means that there's no incentive internally, and it's not something that fund managers will spend too much time on, but there's no incentive for either of us to win, because all of the outcomes, all of the process, everything we do is by virtue of agreement, and where we don't agree, we just move on to the next stock. But there's no internal competition. There's no scope for internal competition. It's very hard for us to express why that's important, but it comes through when you can figure out a process that can be repeated over a long period of time, and I guess we've proven that so far. We're definitely co-investors in the fund, and in fact, I topped up my investment recently and have never taken any money out. So it's a very large sort of investment that we've made personally, and our conservative style, by way of very quick recap, we only invest in industrial companies. We don't invest in the resources sector. We find that too risky. We don't invest in loss makers or biotechs that are yet to commercialise their drugs or their technology. If they're a technology company, we invest in profitable, predictable businesses, and we hold them for long periods of time. Our turnover is typically about 40%, which means we're holding stocks for two to 3 years at a time. And indeed, there's positions that we've got in the portfolio now, which we've held for 15 years, and it's because they've grown very consistently, and we're looking for companies that we don't have to ring every week to see how things are going. We know that their business is resilient enough and also well managed enough that the long-term growth is what we're looking to achieve. And the returns that we're able to get are driven primarily around that, and also around our ability to, with discipline over valuations. It means that when markets turn down, and they will, and they do, and they have, typically that's when capital preservation is the most important. And I'll show you a chart in a couple of minutes that describes most of our outperformance has actually been around the capital preservation when times get hard. So if you can just fast forward a couple of slides, actually one more if you don't mind, Aidan, thank you. So if we just look at the long-term performance of the fund, there's kind of too many numbers here, and the one that's missing, and I'm not sure, I can tell you it anyway, but the since inception, so if you go back 19 years, the fund has delivered 12.5%, which is more than twice the return of the market. So we've outperformed over a long period of time by about 6 or 7%. So in other words, and that doesn't sound like much, 6 or 7% per annum doesn't sound like much, but when you extrapolate that over a long period of time, the power of compounding is very rewarding. So if you had have invested 100,000 at the start, it would now be worth almost 900,000, and if you had have invested in the market, that would be worth 250,000. So that compounding effect is very favourable over a long period of time. Now, what I'll do also, so the last 3 years have been pretty challenging. We would never complain or say that it's been too hard to perform or anything like that, but obviously inflation has has created a large issue that we've had to get our heads around, that frankly most people in our industry haven't had to deal with for their entire career. So it's created volatility, had a big downturn, and then a couple of years of sideways and pretty poor for small caps, and then a very remarkable bounce. So if you look at the last 3 years, we've outperformed by almost 5% compared to the small industrials per annum. Most of that came through in the early period where the market turned down and we had that capital preservation, which we can talk to in a couple of slides again. Then if you look at the last 6 months, you'll see typically what happens in our fund is if markets are slowly rising, we should do as well, if not better, and we have. If markets fall quickly, we on average have done a lot better. And if markets rise remarkably quickly in a short period of time, we're likely to be left behind, and I'll explain why. It's because we're reasonably conservative. We don't like taking irrational risk, and we have very disciplined around valuations, and we don't like junk companies. Now, when markets, and you can see in the last 6 months, the small industrial market is up 23%. That's in half a year. It's phenomenal how much they've bounced. That is what I would categorize as a very hot market, or a junk rally, or an extreme risk-on rally. And I'm not surprised that, you know, we would never apologize for being up 15% in 6 months. But equally, the context is that the market is up a bit more, and that is exactly what we would expect because, you know, if you're outperforming a market that's rising by 23% in 6 months, then typically you are taking a hell of a lot of risk to achieve that outperformance, and it's not our style. If you just, Aidan, if you hit one more slide, in fact, two. This is the key chart. And we've only sort of crunched these numbers in the last year or so and realized that we can graphically show it. What it is that the yellow is the monthly performance of our fund and the blue is the monthly performance of the market. And what it shows you is more often than not, over the period of time we've run the fund, the market has gone up. So you can see on the left, markets have gone up, and when they do, they go up by about 4%, and we go up slightly more in those months. But then in the down months, which is about a third of the time, the average fall is 4.2%, and we're only falling 3%. Now that graph doesn't look that dramatic, but when you extrapolate that over 20 years, that 1% when the market goes wrong is how you can double the overall market performance per annum over a long period of time. So it's a great way for us to describe how we invest, why we invest, and the outcome is exactly what we would have expected. So Aidan, if you hit one more slide, please. So with the sorry, I've just got something I need to click off the screen. So with the we'll narrow down now, and one of the other things we probably should remind you is that we don't. Steve and I are not asset allocators, so we are fully invested within our fund. We assume that anyone who comes to us wanting to invest in small companies doesn't want us to also then say, well, we'd rather sit in cash for 6 months because the market's expensive, or make major macro calls. It's definitely not our skill, and in fact, we should never tell you it's our skill. Our skill is once you've made the decision to be in small companies, we will try and pick the best ones. We're stock pickers. So when we talk about the economic backdrop, it's not because we're looking to time the market. It's just we look at it as it relates to the cash flows of the businesses we invest in, and it's certainly relevant to a proportion of them. So if we look at and equally, I'm not an economist, so take these as observations with someone who's around markets and economies, but certainly I'm not positioning myself as the world's best economist. But a few observations I would make, and that is that the biggest driver of markets and therefore, interest rates, inflation interest rates is the key topic, and they will drive markets. They'll also drive the cash flows of the businesses we operate in and their underlying conditions if they are exposed to cyclical elements of the economy. So we do need to be aware of these as risks. 3 years ago, when we thought inflation could tick up, we removed what we considered to be most of the inflationary risk in our portfolio, and it's selling stocks that don't have pricing power. It's selling companies whose valuations rely very heavily on low interest rates, and selling stocks that are highly geared, which are obviously going to have a cash crunch if rates go up. And that did protect some of the downside when we had the big drawdown in 2022. So from here, we identify the risk of inflation and interest rates as something that is still absolutely unquantifiably alive and it seems to change every month. And it's not. It's just because it's so heavily data driven. To say that there's a common thread of logic, and that is that inflation ticked up, so interest rates rose and pinched the economy down to drive inflation back, and that has worked, and therefore we're moving into rate cut scenarios. I actually don't think that's a very valid description of what's happened. I think what happened is the inflation was largely caused by supply side issues. Rates went up, they didn't affect the supply side issues at all. In fact, usually you would associate rates going up with a hard or a soft landing, and the Australian and US economies are yet to have that landing. Australia is showing a little bit of signs of weakness now, but the economies are still very, very strong. So it's not that demand collapsed to bring back inflation, it's that the supply chain's repaired. So the idea that we would move into rate cuts now, when you've got the following, you've got very tight employment markets, likely wage rises, particularly in Australia with heading into an election year with a Labor government. Lingering inflation, it hasn't gone away. It's not as bad as it was, but it's definitely lingering. And the RBA is making noises around that. A very stimulatory fiscal, or the recent budget. So it's a splash, it's a fairly splashy budget, potentially one more. And the economy that is in good condition, equity markets, so share markets are strong, and property markets are strong. All of those ingredients smell to me like rates would rise, not fall. And I'm not saying that I therefore are forecasting rate rises, but I think it is very bold on those assumptions to assume that rates are going to drop quickly. And really, the most dramatic chart of all is the red line there you're looking at, and that's real rates. Real rates are not high. As you can see by that chart, it's an aberration that we had real rates go so low during what was a bizarre period during COVID. But yes, rates have risen, but with inflation rising, real rates are still fairly low and stimulatory. And in that environment, we would doubt the need for immediate rate cuts. Things can change, data will change, we'll watch it, but certainly as it relates to how we look at our cash flows and our businesses, we would not price in anything around rate cuts. So if you go to the next line, one more actually. I'll explain why I put this chart up, and that is that small companies had what we would call a tough year in 2022. Unfortunately, the chart that I wanted to show now is not popped up, but I can describe it to you. Small companies performed roughly in line with large companies over the last 10 years, except in 2022 when there was a risk of going into recession. Typically, small companies always fall faster, harder, and earlier into a downturn, and that's what happened in 2022. They underperformed by about 15%, and that gap wasn't closed for about until about October last year when the market bounced. And so we had a period of about 18 months where small companies, you can see the turnover, which is the activity, daily turnover of the companies we look at, halved in that period. It meant that a lot of people had left the market. That creates inefficiency. It also creates, for us, it's great news. We love it when everyone else leaves the market. We're stock pickers. We love turning over rocks that not many people are turning over. If you can see in more buoyant times, it's often harder for us to actually find good opportunity because everyone else is looking. But it's more context as to why the small companies did underperform. Because at some point in time, you would expect it to snap back, and I didn't expect it to snap back as quickly as it did in the last 6 months, because small companies have actually outperformed large companies by about 7% in 6 months. It's been a phenomenal bounce, and you can see there also turnover has doubled from the lows. So there's activity coming back into small companies. They're back on the menu for a lot of hedge funds, part-time investors, and others, which is good for. Certainly good for turnover and bringing people back to find where the value is, and we think there's heaps, frankly. So the next chart is another way of describe or another factor in our confidence here, and that is that takeovers. In my career, I've never seen so many takeovers in our sector, and we've got a few names there. The three biggest building material stocks, which have been listed since I started my career 30 years ago, are all under a takeover offer right now. Boral, CSR, and Adelaide Brighton, if that's not a bit of a bellwether as to what's happening. And it's because corporate investors and private equity funds are seeing value that the short-term investors in the share market are not seeing. That's unless they get it wrong, and they could. But anyway, that's the way I would summarise it. And what it means is that the supply of investment opportunities is weirdly shrinking in small companies. There's fewer stocks because there's so many being taken over. So the next chart shows you what we would expect to change. And so IPOs, therefore, takeovers. So the market's back on and risk has been dialed back on, and it'll change month to month, but if that's what it keeps playing out, and takeovers are shrinking the supply, that IPOs will come through, because if you look at the IPO activity for the last 2 years, the IPO market has basically been shut, and investment bankers earn a lot of fees from these IPOs. They're not charities. They can't wait to crank the IPO machine again. It just hasn't been possible because the markets have been too volatile and the turnover has been too low. So what I would expect in the next, so you can see there's probably 2 or 3 years of 2 years of deals there that haven't been done that will be done over the next potentially 2 years, as long as the market doesn't, everything comes with the caveat of no more left field factors, but that could easily, and most IPOs happen in small companies, and that replenishes the supply and the interest in the sector. I might go to the next slide if you don't mind, Aidan. So our portfolio, we do this chart every 6 months, and it's a way of us describing to you what are the characteristics of the sorts of stocks we invest in. And certainly when we started the fund, and right as I look at it now, and I update this every year, and Steve does it every year as well, it's exactly what I would expect and ideally would want. And that is that when we talk about defensive growth stocks, you can see that's about 2/3 of our portfolio. And I would say that the technology stocks, that's 7% there, they're actually defensive growth technology stocks. They're very profitable, and we can come back to that. So it's basically 70% of our portfolio is in businesses that don't have any connection to the economy, or very, very mild connection to the economy at all. So it's businesses like Propel Funerals is the most obvious. It's a funeral business. It doesn't matter how tough times get, their volume is going to be there, frankly. So it's not something that we have to sweat about and wonder about consumer sentiment or anything like that. The volume is just going to be there. And we'll go through a few more examples. Jumbo Interactive is another one, car sales, and the insurance brokers. There's plenty of companies we look at that really don't rely on the economy. And in fact, the telco sector has been very good for us over a long period of time. Again, the telco sector is very, very stable and resilient. So they're the sorts of stocks we, I might just get you to go back one. So they're the sorts of stocks we try and spend certainly most of our time, energy, but most importantly, that's where our biggest investments are by weight within the portfolio and by number of stocks. If we look at and you can see cash there's at 2%, that's about where we would want it to be. We don't want to hold that much cash. Financials are companies like Charter Hall, MA Financial, which used to be known as Moelis, and GQG. So they're largely fund managers. They're businesses that we think can grow strongly over a long period of time. And fund managers are great businesses when they're growing their funds under management, because the costs are stable, revenue rises, and profits rise quicker on a stable cost base. But we also acknowledge that no matter what you do, if you're growing a fund management business, you can, and that they all have this, or most of them have this attribute anyway. That is, no matter what you're doing as you're growing, you are still day to day at the mercy of the direction of markets. So you can be growing and cyclical at the same time. So we just isolate that as a risk, because if you get a correction in the share market, those sorts of stocks do underperform. So we've just got to make sure that we're not heavily exposed to them. And 9% feels like it's about right. It's been up to about 15% in various times, but that's about right. But as I said, we're not going to invest in fund managers unless they're growing. And then if we look at cyclical stocks, the sorts of companies that we have exposure to that we would classify as cyclical also have underlying growth. So they're not just, it's not just play the cycle. It's that they might be, something like Breville, for example, a phenomenally strong global growth business there. I think most Australians think of Breville as a pretty sleepy brand, but overseas it's seen as a very high-end, exotic, very expensive brand. It's more like one of the German brands when they sell into overseas markets. It's growing phenomenally, but equally it's going to be exposed to economic activity. Seven Group we'll come back to in a minute. That's another cyclical. And Webjet, for example, that's a business that we think can double in its revenue over the next 5 years. But equally, there's no hiding whatsoever that they will, if the travel cycle tips over, then they will be affected. Anyway, that's just a sort of a good way of describing in a summary sense what our portfolio typically does look like, and we would want it to sort of, over a long period of time, we wouldn't want it to change too much from that. But the stocks always change. It's more the characteristics of the things we love. So we'll go through a few stock stories now, excuse me, and then we can open it up for questions. Jumbo Interactive is one of our top 3 holdings. It's about 5% of our fund, which is a very large position for us to take. And we've known the stock for a long period of time. In fact, we did very well. You can see it had a huge run. Now, Jumbo Interactive is the largest reseller of Tats tickets. It's Lotto, basically. They sell them online, and there's only 2 ways you can buy it online, and that's via Tats or Jumbo Interactive. Great business, started by an entrepreneur in the 80s, and he still owns 13% of the company, is very, very heavily involved, very successful, clever individual. But what happened, you can see there, we sold out a few years ago, and thankfully we got out at the right time. What happened is the only cyclical element of Jumbo, Tats tickets are like bread and milk. People just go and get them every week. It's not cyclical. It's like dog food, and we can show you in a second how. But with one exception, and that's when you get huge jackpots, it brings in the last few, and it's a bit of a party, and then you get a boost in sales. And then if there are no jackpots for a while, those people leave, and the profits can actually fall. That's exactly what happened. We sold when there were jackpots on a run, and just thinking, well, if there were no jackpots, this thing can actually have a profit drop, and the valuation didn't support that. So we actually only bought back in about 12 months ago when we were satisfied. You can see the stock had done nothing for 4 or 5 years. We were satisfied that the valuation had reflected now, and when we had a pretty poor run in jackpots, we were satisfied that the valuation reflected more rational pricing. But the next chart will show you why we own it. And that is that the top half is the proportion of tickets for Tats Lotto sold online compared to going to your news agency. And it's gone from 13.5% to 40% since financial year 17. Now, remember, these guys are one of the only 2, and they have half the market. Now, most markets in Europe are sort of 60, 70%, some of them. So we still think that there's at least 50% growth to come through penetration. Ultimately, I don't know why anyone would go to a news agent. I mean, I don't want to offend anyone. People might love the news agent's visit, but it's going to slowly fade, as these things do. And equally, the ticket sales on the bottom half show you that when there's a downturn, it's not because the economy has tipped over, because you can see, when the GFC happened in 7, 8, and 9, or 8 and 9, ticket sales still rose, and it's because that's what they do. It's a mild growth industry, but they only fall when there's a bit of a quiet jackpot period, which is random. So we think that can grow for a long period of time. The next one is another large holding of ours. It's about the same size of the position. We've held car sales for a number of years. Amazing business. We bought a lot more 12 months ago on the basis that we'd finally sort of done enough work to realise 2 things. Firstly, it's not as cyclical as we thought it might be, and we'll show a chart in a minute. And equally, when they bought into overseas businesses about 4 or 5 years ago. Now, typically, we've been around long enough to know that most Australian companies, sadly, when they go overseas, it doesn't work. They overestimate their ability to run businesses in vastly different markets, and it's a bit of a graveyard. So we're a bit nervous about their overseas expansion. Those nerves have proven, it's good to be nervous. We should be. But they've absolutely nailed it. They've grown profitably in Brazil, the US, and Korea, and we think they can continue to do so. So if you look at the chart afterwards, this shows you blue is the sales and yellow is the profit of the company, and you can see all through the GFC, through COVID, through a shortage of used cars. You can see there's a whole range of time periods there that have shown that it doesn't really matter. This company has grown. It's grown through price increases, additional services, advertising on their site, and they even now will buy your car. So if you're selling a used car, instead of selling it to a used car dealer, you can sell it directly to Car Group. They're called car sales, and they'll buy it. They've got the best ability to price it because they are the market, so to speak, and they've also got the best avenue to sell it because they just put it back on their site. And you will get a better deal from, as far as I know, and the company's very confident on this. You'll get a better deal than you would do through selling it to the dealer directly. So that's why they've been growing. We think they can grow in Australia at sort of 5 or 10%, and very, very much faster growth in the overseas markets for a long period of time. I love charts that look like that. They build slowly, and I hope if I'm here in 10 years and I show you that exact chart, it looks exactly the same, and we've owned it for a long period of time. Anything can change, but that's why we like it. We'll go to the next one. Seven Group is this is the largest business within Seven Group. It's a conglomerate, and because it's a conglomerate, it's not perfect. And equally, there's a large family ownership, with the Stokes family owning 56%. Now that rests an element of control in a family that is, potentially not as predictable as what you would call a traditional ownership structure. It's not to say they're bad or stupid or dangerous. It's just that they do have control, which we need to be aware of. And so, therefore, this is not anywhere near as big a holding for us as it would be if it was a single focused business. So anyway, the largest business, we've owned a number of years. We've taken a lot of profits over the last 12 months. You can see it's doubled or more than doubled in the last 18 months. We've sold a lot of our stock. In fact, probably 2/3 of it. The next chart shows you our major appeal. This is the biggest division, WestTrac. It's about 55-60% of earnings, and they sell huge yellow trucks. It's a Caterpillar reseller, so they're basically a seller of trucks to people like Fortescue and Rio and the like. And yellow is the capital sales, so that's the rate. This is the sales history. That's the amount of new trucks they're selling. But the best thing is, when you sell a new truck, you then follow up with service, parts, and you get a nice recurring. That's the really high quality income. That's what your mechanic loves, that you go back there every 6 months or whatever it might be. And you can see that's been growing steadily as well. And we think that can continue to do so. The next one is a good example of just a small, it's always good to show you a bit of light and shade. When we talk about things like Jumbo Interactive and car sales, we've got 5% of our fund in it. So the fund's about 700 million. So that's investments of 35-ish million dollars. This one is $3.5 million. So it's a much smaller holding for us. But so what we wouldn't bother with companies that are, or investments that are that small, unless we thought it could do very, very well over a longer period of time. It's just that the risks are higher. The Catapult is Australian technology. It's the global leader in wearable devices that give feedback on athletes' performances during competition. So the AFL's been wearing them for years. They're tiny toggles on the back of the neck, and they give you the heart rate and the change in direction and the speed and the acceleration and change in acceleration fatigue, all these sorts of data points, which in modern sport, if you think how everything now is a game of millimeters, milliseconds, then data is so important. Big teams, huge money, you can imagine. So they've just moved into Formula One, for example, and you think about the amount of money that is thrown by Ferrari and its sponsors at those cars, and they're just trying to beat the other guy by 0.01 of a second. Then data is often the last bit or the value of data, or perceived value of data, is very high, and the budgets are enormous. So they've been growing in the order of 20%. We held this stock years ago and did very well again, and you can see it spiked up, and then we sold out. We didn't quite pick the top, but around that sort of $3.50 mark in the past, and that was because they moved into the US market with a couple of acquisitions and started to overspend, and they started losing money. And that's not our. Once that happens, that means that the risk for us is too high. So we sold out, and you can see it did nothing for 5 years, probably 6 years actually. We revisited under new management about a year ago and had a couple of meetings and thought, oh no, these guys are actually pretty clever. They've trimmed back on all the marketing spend. They've narrowed the focus of the product. They are still, notwithstanding 5 or 6 years in the wilderness in the share price sense, they are still the number one in the world. No one's been able to knock off their technology. And they sell into 100 countries. So you pick a sport and they're probably selling into it. It's enormous, but they've got a tiny proportion of the market. So and they're profitable again. We like the focus of the new management team and the fact that the growth potential is still very strong. If you look at the next chart, and the other thing is important to realize that these guys when they sell their product, the teams pay them on a recurring basis. So rather than having to sell one unit, i.e. tag, and then sell another one or sell two the next year to grow, it's compounding growth, which is much higher quality revenue. And when you look at so it's a software rental business. When you look at software rental businesses, these are the sorts of things you want to see. The top shows that their market share is increasing. The grey bar is the amount of customers that buy more than one product. And software companies will always, it's all very well buying one, but hey, what about the other product and the other and the other? The higher, obviously, you earn more revenue per customer if you do it that way, but it creates a stickier customer. And the bottom line there is the churn, which is falling. So so the growing market share, they're selling more units to each customer, and customers are staying longer. They're exactly the metric on a software business, and equally that it's got a massive market potential. It's in their words, if you go back to slide 8, and in their words, their market is $40 billion US. So if they get anywhere near, if they're able to add the additional revenue streams through clever technological expansion, then this is the sort of stock in 5-10 years could be worth a hell of a lot more. So that's, and then insurance brokers, I'll just touch on briefly. Anyone who's followed us over the last sort of probably 5 to maybe even 10 years may have heard of us talk about this sector. So the insurance brokers, it's 3 companies, AUB, PSC, and Steadfast. It's been our single biggest investment by sector for probably in the portfolio for a long period of time. We've held Ausbrokers for 15 years plus, and the others for a long period of time. And it's because there's a lot to love about the industry. It's very stable, and it was an industry that was consolidating. So the 3 listed players weren't cutting each other's throats. They were buying private businesses and rationalising the industry. Now we've sold more than half our position in the sector and potentially more. And there's 3 reasons. The first is the share prices have done very well. So we're happy to take profits, and we're struggling to see as much upside as we used to, and it's been quite rewarding. The second is that the industry rationalisation. Once you if you take a fragmented industry and you rationalise it, you can't do that twice. Because if you get 3 players that were hoovering up the small players, and then all of a sudden they're roughly a third of the market each, they can no longer buy anything. They have to go overseas, which they have done, and we think that that's not to say they're destined to fail, but that is always high risk when they go overseas. So there's that, and then the insurance pricing. So we all know this from home insurance and car insurance. But as a broad category, insurance pricing is quite cyclical. It goes through long cycles. It tends to be 5 to 7 years, and that's very rough, by the way, because each cycle is different. They'll rise for 5 or 7 years, and then they'll drift back for 5 or 7 years. And it's because the major insurance companies all start losing money when the rates are low, and everyone they'll try and creep rates up to get the returns back. And then at some point in time, when rates are good or too good, someone will break ranks and start stealing market share by cutting prices, and that's the downturn. So pricing in insurance has been going up for about 6 years, and by about sort of 4 or 5%, depending on the category. In the last 12 months, it's 15 to 20%. We've all seen it in our household insurance. It's a good bellwether. Not all lines have gone up by that much, but it's phenomenal melt up, if you like, in insurance rates. Now, that does have positive implications for the insurance brokers who have underwriting agencies, which AUB and Steadfast do, as well as being brokers. Now, we're not saying that we have intelligence that says that the rates are going to fall from here, which would be bad for profits and we think would hit the share prices. But we think after 5 or 6 years of strength and a big blow-off year, typically, no one's going to ring you at the top of any cycle. No one ever rings a bell. You just find out in hindsight. And I think we're much better now selling out of most of our position here, which we have done, and waiting to see if our inkling is right, and that is that it's hard to see another 5 years of strength in insurance prices. And if for some reason we do get a drop in insurance prices in the next couple of years, then it actually is bad news at the margin, bad news for these companies which have a lot going for them, but we're not going to hang on the risk that there might be a hit to earnings. So that's a summary. The top 10 holdings is on the next page. And I'm happy to chat at any level on markets or what we do specifically or individual stocks where there's interest.
We have got a few questions that have come in. Just a reminder, if you have more, please enter them into the Q&A box, which can be accessed on the bottom of your screen. But up front from me, you spoke about Jumbo, who sell lottery tickets. Can you please just clarify your position with respect to investments in companies that are involved with gambling?
Absolutely. So, excuse me, we have an exclusion to companies that are involved in or heavily involved in gambling. So I'm trying to think of examples. So Red Cape was a listed hotel business that we weeded out because it was too heavily reliant on pokie machines. We've never held the pokie machine companies or the designers of the software. We're philosophically opposed to it. We don't think pokies are a leisure activity at all. We think it's a tax on people that shouldn't be taxed. But that's our philosophy. But lotto tickets, we don't see the same level of addiction and preying on people in vulnerable positions. We think lotto, and we'd be happy for other people to have a view that and to discuss that. But we think lotto is far closer to a relatively harmless leisure activity. That yes, there's money at risk, but it's nowhere near as addictive and destructive as pokey. So that's our interpretation.
Okay, thank you. The next question, I normally avoid very long questions, but I think this is a particularly good one, so I'm going to ask it next. You have made the point that active management is required in small caps, and your track record does back that up. But in an age of passive, which means that price drives flows, which drives price, and so on, these flows are typically into larger cap indices. We've seen that all around the world, and we've seen large cap indices outperform small. So I know you referenced a pickup in the interest in small caps, but in today's environment, what is the case for investing in small caps going forward?
Yeah, well, so again, it's a shame there was one chart that I thought was there that has disappeared, but it shows over the last 10 years, small companies and large companies have performed exactly in line until 22, and then small companies underperformed, and then in the last 6 months they've outperformed. Now, I've read plenty of, for my whole career, the death of small caps gets announced every 6 months for various reasons, and I've watched that and I don't believe it at all. So if I can just explain, so if it was a problem, because passive investment was also a dramatic driver of change in people's investment habits over the first 8 years of the 10 years I've just described, and it created no divergence in performance in small caps versus large caps at all. And the underperformance we saw in 22 is exactly in line with every recessionary situation in the US since the data is available. Small companies always fall harder, always bounce harder. It happened in the GFC here. So for all of the it's new and it's different and it's a tougher market, I don't think it is. It's always a tough market. We just assume small companies is always tough, and we're just stock pickers. But then the other thing is, the idea that passive money, weirdly, I would say, and I can't prove this, but I think what is it, about 50% of the market is now in ETFs. What that does is create very strange flows at the day-to-day stock price level in companies. We're only interested in the individual stocks. And I can give you an example. You might have an index change where a stock has done poorly and they're ejected from the index, and the machines, which are the ETFs, will just automatically, there's no people involved, they just sell those stocks. If you get 2 or 3 funds at the same time doing the same thing and liquidity is not that low, they'll fall by 30, 40%. We're there to look for those sorts of things. And that to us is music to our ears, because what we would categorize, and I don't want to be personal about this, but that's dumb market moves. And I'd say it just in a sort of a passive way. We love, and that's probably a better word to use, is inefficiency. We think the passive side of things at the small cap level actually hasn't hurt. It's actually increased the inefficiency. We're looking, our whole world revolves around finding stuff that no one else wants, or has tipped out at the wrong price, or has not done the homework to realize they can grow over a long period of time. And if people have moved to passive, then that actually exacerbates or sort of increases the inefficiency, because flow is more important than actual fundamentals, and that's great for us.
Great, thank you. That was comprehensive. Next question. Can you clarify the market cap bounds for your investment universe? How big will you go and how small will you go?
So the upper limit is the top 50, which is about, at the moment, about 8 billion. And we don't spend a lot of time up there. We do own 2 or 3 stocks that are in the sort of, in the sort of 3 to 5 billion range, I guess. And then the lower end, we look at companies, we're open to companies that have free floats. So market cap that is not held by the founders or big shareholders of about 100 million. It's very rare. We look at a lot of those sorts of companies. We love looking at them because when you find the right one, they can be hugely rewarding, but we don't actually own many of them. It consumes, they're great opportunities when you get comfortable. We say no to most, put it that way, because you're taking more risk. And any time you invest down there, it would be a tiny position in our portfolio. It'd be like 0.5%, because the liquidity risk is higher.
Great, thank you. I've got two questions now about ABB. The first is that the company's made a series of large acquisitions, which could be risky. How do you assess the risks of integration? And the second question is, on what basis have you invested in ABB, given that they are yet to make a profit? Great potential, but have they produced the results? So please can you talk a little bit about that company and your reasons for investing?
Absolutely. So I'll take the second one first, just because I remember it. So the company, when they listed, it wasn't profitable, and we didn't invest in it because and when they listed, it was actually really small. It was primarily, in fact, solely a household broadband reseller. But they moved into profits within 6 to 12 months of listing. We established a small position, but I reckon that's probably 4 years ago at least. They've been profitable since. So their EBITDA, I don't have it right in front of me, but it'll be 100 million. They're actually a big company now. So they've changed, and a lot of that's come through acquisitions. So certainly that side of it is ticked off from our point of view. And then if we think about the integration of acquisitions, so as a broad comment, I would tell, and we've said this for years, we don't mind investing in companies that go via acquisition, but we much prefer those that grow organically. It's much lower risk. It's so easy to buy. We've watched this for years. It's so easy to acquire companies and think it's going to work. It's so hard to make it work. It's always risky. So that's a broad brush statement. Then when you look at acquisition strategies, they are actually quite different. If you're a business that's buying ophthalmologists, for example, you've got to hope that whatever you paid for the 3 key ophthalmologists' business, you've got to hope the only way the value is there is if they stay, the 3 individuals. You've got to tickle their belly. There's egos involved. There's culture clashes. If they leave, you've lost all of your value. It's risky. And the same with your merged law firms, or I'm trying to think of those sort of very heavily reliant on individuals that have very strong power, so to speak. Telco businesses are at the exact opposite of the spectrum. They're not completely without risk, but they're much lower risk. And that is that when 2 telcos merge, the management teams obviously have to get along, and that's a risk. And just so you know, to manage the risk, because we do identify it, our holding in AUB would be about 2.5% of our portfolio, which says to you, we like it, but nowhere near as much as a lower risk proposition like Jumbo Interactive or Car Sales. But then, so going back to merging 2 telco businesses, in effect, if you get the people bit right, and people, they're not big people businesses. Telco businesses are largely marketing operations and billing engines and networks, ideally. The more network, particularly fibre network they own, the better. So when you merge it, you're not actually trying to bash together huge cultures of very important ego-based management teams. What you're trying to do is get the technology, well, you keep your sales force intact and your customer service, those sorts of things. Your billing engine, it goes without saying, if that falls over, you've got no business. And billing engines can be risky to merge them, but you know, to date, it's certainly that hasn't been an issue with Aussie Broadband. And then the network usage is where your cherry is on top. So if you've got a network and you buy someone else that's using Telstra's network, you can just shut the operation with Telstra straight away and put it on your own network, and 1 and 1 is 4. And so the best stock we've ever owned in our history is M2 Communications. That was phenomenally successful for us. We bought it at 20 cents, or probably 20 to 25 cents, and it got taken over at $8. Vocus was very successful for us, TPG. And so the history within the telco industry and small caps is that acquisition-driven stories can be very, very rewarding for the reasons I highlighted. But nothing's without a risk. So we're very alive to those risks and would be ready to change our mind if we think they were blowing out.
Right. Thank you. Your ophthalmology example is a great segue to the next question, which is you and Steve have been managing this fund for 20 years. How long are you planning to continue this for?
Is it because we both wear glasses that ophthalmologists reminded of you of us?
I think somebody may have been looking at the amount of grey hair that we both seem to have these days.
So how do we? It's a good question. So when we started the fund, I don't think we thought we would go for 20 years. I'm not sure if you make any plans for 20 years, but maybe you do. Nothing's changed for us. It's so much fun doing what we do. If you think about our approach, we don't need to reinvent the way we run our business day to day. There's just two of us. It's relative. There's no committees. There's the bureaucracy is obviously we've got compliance and all those sorts of things, but we're not spending a lot of time on meetings that we don't want to have. We drive all of our company meetings. We're meeting CEOs and entrepreneurs and very, very interesting people. We're meeting a company a day, if not more. So it's actually for something that looks on paper like it hasn't changed for 20 years. It changes every day, and that is because the contact we have with these very, very interesting people, and then we love the riddle of, okay, is it going to grow? What could we miss? Where could we be wrong? Who's expecting what? Why would someone sell something to us? All those sorts of things. It's actually really engaging. It's never boring. I've never looked and thought, oh God, this is not this again, because it changes so much. And then if you think about what we would do, and obviously if you get, we haven't choked each other to death, so that personal conflict thing has been so far, first 19 and a half years has been reasonably placid. And then if you think what else would we do within, where our ownership structure of this is that we have no incentive to go and look anywhere else within Pengana. We have no incentive to start other funds or get distracted with other things. And we haven't changed, as I said, we haven't been distracted. We haven't done a single thing different in the whole period. And it's because it is fascinating to be doing what we're doing within the structure and not having to, we don't have to manage teams. I'm not doing staff reviews. I'm not getting bogged down. Some people on the call probably are, and maybe they love it, maybe they don't. So we've still got heaps of energy and love it.
Okay, great. So to summarize, you guys are both sticking around for many years to come. What changed your thinking on Hub? This person had the impression from some years ago that you weren't crazy about that business.
So no, we've held this stock for, I can't give you the exact period of time, but I remember when we bought it, it was $4 something, and it's now 40 odd. We've had if we've ever expressed any sort of misgivings, so we've never sold out ever, and in fact, about 2.5 years ago, we bought more, quite a lot more. But the position size, so just so you know, we have about 3% of the fund in Hub. So again, it's not 5 or 6 or 7, which we could do. And that shows you that we like it without wishing to bet the whole farm on it. So no, we love Hub. The story is intact. They are, as far as we are prepared to invest, they are the best of the growth platform businesses between Netwealth, Hub and Praemium. And they've definitely outperformed both in fund flow and share price by a lot. We do own the other two. We've got a tiny holding in Praemium, which has been a bit of a problem child, but Netwealth we hold. We just don't think it's quite as good. It's not to say it's bad, but all of them are taking market share from the old platform. So it's a bit like when Telstra went from being a monopoly to slowly losing market share to the other players. That's what's happening with the banks and the old platforms. They're slowly losing and steadily losing market share to Hub and Netwealth. And between the two of them, they're still only 10% or less than 10% of the market. So we think we could be sitting here in 10 years' time and they could be 30, 40% of the market and therefore 3 or 4 times as big. Now, the reason we don't have the world's biggest position in the stock in terms of the bet size, so to speak, is that it's not without risk. In the valuation in the short-term sense is actually quite ritzy. It always has been. It was expensive at $8 and it's now 5 times the price. When I say that, I mean, our valuation shows over a cash flow, a risk-weighted cash flow assessment over another 10 years that it's worth a lot more, but the risk is higher because you have to assume longer-term growth.
Great. Now, the questions are still coming in thick and fast, so I'm going to continue to ask them, but ask that you are slightly more succinct in some of your responses, particularly this one, which is going to be a big question. Can you talk briefly about your main detractors in the past 6 months?
Yep. So that's a chart which Aidan will be able to show you. If you go back to about slide 3 or 4, lifestyle communities, that's the worst. We sold most of that stock when it hit $22. So the pain it's caused us has been much less, but they've had some slippage in sales and they raised money where we were surprised, and we expected them not to. But the position within our portfolio is quite small, so the pain wasn't too bad. Where are we then? You've got Hansen Technologies. They bought a business overseas, and we've reduced our position size accordingly. They've taken a bit more risk than we think they might otherwise ought to have. Aussie Broadband, there's just been, they actually lost their number one white label account, Origin Energy, and that was the only account they had, so you can't lose more than 100% of that line of business, but it did hurt the share price. Ausbrokers, or AUB, as I said, we had sold a lot of that anyway, so it didn't cause us much pain. And Worley was the other one, it moves around a bit with the oil price, and I would call that probably noise. If nothing else, well, they had a problem with a subcontractor in Ecuador, which, frankly, it hit the share price. There was a corruption charge. Whether or not that actually comes to anything, we'll wait and see. But it's hit the share price in the short term.
And are you planning on participating in the AUB capital raising?
We literally got off. We had a call at 11, so Steve and I will need to chat on that. But so we haven't made a decision.
Great. Next question: do you have a position on energy markets? I'm guessing that's a view.
Which specific part of the energy market? I'm not.
It's just a question. Maybe we can leave it and go on unless you feel that oil or unless you have a specific view about oil or something else, the oil price.
No, we certainly don't have a view on oil or commodities in general. We don't do that, but it's a difficult question to answer. If it means energy transition, where are the other opportunities, then that's one question, or if it's energy pricing, it's another. It's hard to know. I'm happy to be clarified on that, but I'm just not sure how to attack the question. Sorry.
Perfect. The person who asked clarifies it. Maybe we'll get to it at the end. Can you provide some further context to your comment about the heaps of value you felt existed in the portfolio and the market?
So everything we own, we think is worth more. Would be a good starting point. And as we were sitting there patiently this time, before October last year, there were stocks that we thought were. We don't say this because we're cocky and we're just, oh my God, the market's so stupid. How do they not see the absolute value? It's a lay down misère. It's not that we were just comfortable that the stocks we held, once we get through whatever this inflation or interest rate cycle does, there is enormous value to be recognised because there's good underlying growth in earnings coming through in so many stocks. So, but there were some real real outliers, particularly the smaller end. So what happened in small stocks is when small companies go out of favour, the small end get completely ignored, and that was where we saw particular value. And some of those have bounced pretty strongly already, but we're still pretty comfortable. But everything we own we think is worth more, but equally we're nervous about holding everything because I don't want to ever say that we don't, that nothing makes us nervous. It's wrong. We're nervous the whole time.
Great. Just from a team dynamic perspective, do you and Steve do all the analysis yourself, or are there any people in the background? What extent do you rely on external research, etc.?
So there's no one. It's just Steve and me, and has been from day one. We talk to brokers, mainly about conversations. They might have a certain insight or industry contacts that they have that we don't. But we don't use their forecasts at all. We do all of our own forecasts for cash flows, and to make sure that if there are errors, we understand what they could be. We don't want to inherit other people's errors or take their opinions.
Makes sense. In Steve's last update, he was very cautious about the outlook for inflation. Now that you seem to have the view that inflation has peaked, has this triggered any changes in your portfolio?
No, not really. No, because we're still not convinced that inflation's gone away. With wages are still yet to come through. Inflation, history shows that inflation doesn't just light up suddenly and then go away 6 months. there tends to be echoes, and it's mainly because wage inflation is the secondary effect, which then needs to be countered with raising prices, which is inflationary itself. So no, we don't think it's gone away, particularly with the budget. You know, it's going to be it's hard to imagine it going back to 2%. Miraculous.
Thank you. We still do have questions that are coming in, but in the interest of time, I'm going to wind up. Thank you very much for joining us. I think I probably always end webinars for this fund with a similar message. That's because whenever I listen to Ed or Steve presenting, the phrase "a safe pair of hands" leaps to mind. It's a consistent process. It's been followed for almost 20 years. They're not doing anything too exotic or too exciting. They are just sticking to what they know best. So hence the safe pair of hands. Thank you to everyone who submitted questions. There really were some excellent ones made for a very interesting conversation. If we didn't respond to your question, or at least a version of your question, we will get back to you directly. And if you have any other questions, please get in touch. We always love to hear from our investors. Thanks again, and enjoy the rest of your day.